Today we will talk about brand new Double RSI Trading Strategy. How to win without losses. Trading in financial markets requires a deep understanding of price action, trends, and momentum. While many traders use various technical indicators to make their decisions, few strategies provide the precision and reliability needed to minimize losses and maximize wins. One of the most widely used indicators in trading is the Relative Strength Index, RSI, which helps identify overbought and oversold conditions. However, a single RSI often generates false signals, leading to premature entries and exits. This is where the Double RSI trading strategy comes into play. By using two RSI indicators, one with a short period and another with a longer period, traders can filter out weak signals, confirm strong trends, and significantly reduce losses. This strategy enhances accuracy by ensuring that trade signals align with market momentum, making it easier to identify high-probability opportunities. Unlike traditional RSI-based strategies, the Double RSI strategy allows traders to stay in profitable trades longer while avoiding unnecessary losses caused by market noise. In this video, we will explore the mechanics of the Double RSI strategy, how to set it up, the best conditions to use it, and how it helps traders win without losses. Whether you trade Forex, stocks, or cryptocurrencies, this strategy can be a game changer when applied correctly. Understanding the RSI indicator. The Relative Strength Index, RSI, is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100, with readings above 70 indicating overbought conditions and readings below 30 signaling oversold conditions. The RSI is commonly set to a 14-period default value, which provides a balanced view of price momentum. However, the problem with using a single RSI is that it can often produce false signals, especially during strong trends. Prices can remain overbought or oversold for extended periods, leading to premature entries or exits. This is where the Double RSI strategy comes in, helping traders filter noise and execute trades with higher precision. What is the Double RSI trading strategy? The Double RSI strategy is based on using two RSI indicators with different timeframes to confirm trade signals. The first RSI, often called the fast RSI, is set to a 7-period to capture short-term momentum. The second RSI, known as the slow RSI, is set to a 14-period to provide a broader trend perspective. By combining both, traders can avoid entering trades too early or too late, significantly reducing losses caused by false breakouts or trend reversals. When the fast RSI crosses above the slow RSI, it signals a potential uptrend and a buying opportunity. Conversely, when the fast RSI crosses below the slow RSI, it indicates a potential downtrend, signaling a short selling opportunity. By ensuring that both RSI values confirm the trade direction, the probability of success increases significantly. How to trade the Double RSI strategy. The Double RSI strategy is effective in both trending and range-bound markets. To enter a buy trade, the fast RSI, RSI 7, must cross above the slow RSI, RSI 14, while both RSI values remain above 30. This ensures that the trade is not taken in weak market conditions. Additionally, traders should confirm that the price is trending above a key support level or a moving average to strengthen the validity of the trade signal. Once the position is open, the trade can be exited when the fast RSI crosses below the slow RSI, indicating a weakening trend. To further manage risk, traders should set a stop loss below the recent swing low and consider taking profits at a key resistance level. For a sell trade, the fast RSI must cross below the slow RSI, confirming bearish momentum. Both RSI values should be below 70 to ensure the market is not in an overextended phase. Ideally, price action should also be below a key resistance level or a moving average, adding extra confirmation to the trade. The position should be exited when the fast RSI crosses back above the slow RSI, signaling a possible trend reversal. A stop loss should be placed just above the recent swing high to limit potential losses, and profits can be locked in at a key support level. Why this strategy reduces losses? One of the primary challenges traders face is avoiding false signals and premature trade entries. The Double RSI strategy addresses this issue in several ways. First, by requiring double confirmation, traders avoid reacting to isolated RSI movements, which can often lead to whipsaws. The slow RSI acts as a trend filter, ensuring that trades are only taken when market momentum is strong. This significantly reduces the likelihood of getting caught in weak or choppy price action. Another key advantage is the dynamic exit strategy that prevents traders from holding onto losing trades for too long. Many traders make the mistake of waiting for RSI values to return to extreme levels before closing a trade, often leading to unnecessary drawdowns. By using the fast RSI crossing the slow RSI as an exit signal, losses are minimized, and capital is preserved for better opportunities. Additionally, the strategy works best when combined with support and resistance levels. Instead of blindly following RSI signals, traders can improve their accuracy by ensuring that buy trades align with key support zones and sell trades align with resistance levels. This extra layer of confirmation further enhances the probability of success. Another reason why this method is so effective is its adaptability. The RSI settings can be adjusted based on market conditions, making it a flexible tool for traders of all experience levels. If markets are highly volatile, traders can tweak the fast RSI to a 5 period for even quicker signals, while keeping the slow RSI at a 14 or 21 period for added stability. This customization allows traders to optimize the strategy for different asset classes, including stocks, Forex, and cryptocurrencies. The Double RSI trading strategy offers a powerful way to improve trade accuracy and reduce losses. By combining a fast RSI with a slow RSI, traders can filter out weak signals, avoid premature entries, and execute trades with greater confidence. This strategy is particularly useful in trending markets, where momentum shifts need to be identified quickly and accurately. Although no trading strategy can guarantee 100% success, this approach significantly enhances the probability of winning trades while minimizing risks. When applied correctly, along with proper risk management techniques, the Double RSI strategy can be a game changer for traders seeking to achieve consistent profitability. By understanding its mechanics and practicing its application, traders can develop a disciplined and systematic approach to the markets, ensuring that they win more and lose less. What do you think of our video? Let me know in the comment section below. Also subscribe to our channel before you go. Thanks for watching.